The Prescient Equity Income Fund aims to produce income from dividends that is greater than its benchmark Swix index. Since its inception and for the 10 months ended 23rd November, the fund has returned 23% against the Swix index, 17.6%. Joining us from Cape Town to discuss the way the portfolio has been constructed is Adriaan van Niekerk from Prescient. I think Warren, take it from here.
Thanks, Bronwyn. Adriaan, we just wanted to, first of all, understand the rationale for this fund. You've come to market with, it's still quite a new fund, it's 10 months old, and it's an equity income fund. So just tell us what the rationale and the reason is for this fund and what it aims to achieve.
Sure. Hi, Bronwyn. Hi, Warren. I think the equity income fund, we see a great demand at this point in time for dividend type funds with interest rates being very low all over the world. We think it makes a perfect good choice for investors to go into a high income yielding strategy where typically you can see that the dividend yield on this type of fund is just a bit lower than money market rates. So it makes sense in this type of environment.
Of course, we're very familiar with the chase for yield globally, but you're saying that this is one of the products or one of the outcomes of the quest for yield around the world, both in the developed markets and the emerging markets. The fundamental difference, though, is obviously that the dividends are expected to grow, whereas the yield that you can get on the money market instruments are expected to stay at the same rate. What's your view in terms of being able to grow the dividends both for the market as a whole and within this particular portfolio?
That's a very good point, Warren. We believe that in the longer term equities will grow and you will see the dividends grow in time. But there is some capital risk that you have to take. Obviously in this fund there's no protection, it's a 100% equity fund. But if you look at dividend streams on its own, you would find that dividend streams are generally less volatile than the equity prices themselves. So this is a long-term strategy and we think it's very well suited for retirement type products where you don't pay dividend withholding tax as well.
I just want to focus now on your sector exposure and looking at the index sitting with about 27.1% of financials. In terms of your model, you're sitting at a 39.5, which is some 12.5% higher than the index. This is obviously a big focal point for you, the financial sector.
Yes, Bronwyn. If you look at the financial sector, it's really made up of 3 subsectors and all of them are currently giving very healthy dividend yields. I think the most obvious one there is the property stocks that you would find in the financial sector, and we do have quite a bit of exposure to the property stocks. They are still yielding some very attractive yields. They are also growing their dividends, so it's not like a preference share. And then secondly, if you look at the life assurers, they are yielding in excess of what the Swix is yielding. And then you also find some of the other financial stocks like Coronation, of course, also a very nice yielding stock, the likes of Investec, and also some of the other banks.
Adriaan, just to follow up on the question there around the different sectors, I'm always interested to know with the listed property being benchmarked to bond yields, are you expecting their yields to grow any faster than the market as a whole?
Do you mean the property sector relative to the normal equity market?
Yes, I'm saying, are you expecting to see listed property distributions grow faster than dividends in non-property companies?
Well, we won't really forecast for that to happen. I mean, therefore you have to go and look at a macro view of what you think the property sector will do in the next couple of years. We do believe that the property sector will be able to at least grow their dividends. But if you just look at the level of the dividend yields in the property sector, it is still a lot higher than normal equity stocks.
Adriaan, you are also overweight on your telecommunications sector focus by some 4.9%. Can you break down your telecommunications exposure there for me?
Sure, Bronwyn. If you look at the stocks in the telecommunication, you basically have MTN, you have Vodacom, and you have Telkom. That would be in our liquid universe. Now, our overweight is mainly in MTN and Vodacom. Telkom at this stage is not yielding anything, so we wouldn't have a position in a stock that doesn't have no dividend income. So at this stage, our top weight is in MTN. It is also the biggest stock in the index, in the Swix, and then Vodacom is a very healthy yielding stock. I think it's yielding above 6% at this stage. So it makes sense for us to have those two stocks in the fund. They also have good sentiment, good momentum behind them, and that's also important for us in this fund to choose our stocks.
Adriaan, just to make this distinction between the value trap and stocks that pay good dividend yields and are capable of growing those dividend yields, your sector allocations and your stock picks are very much a function of what you've designed in your model. Can you just tell us some of the ways that you try and protect yourselves from, or the model from, selecting stocks that might be value traps and offer very juicy dividends but have no real prospects for growing them? How do you sort of manage that within the model that you manage to get the stocks that you ultimately select for the portfolio?
That's a very good question, Warren. First of all, what we do is we look at dividend yield, but we know there is a big risk in purely just selecting the highest dividend yielding stocks. A good example of that was in March this year. If you look at the Dividend Plus index, they just choose the highest yielding stocks on a forward basis, and Telkom at that stage was still forecasted to have a dividend yield of 8%. But subsequently, government decided that they won't go into the KT deal, and they cut the dividend to 0. Now, at that point in time, the sentiment was already very bad in Telkom. Now, our model picked that up. The momentum was very bad. We saw it at a high dividend yield, but in combination with the sentiment and the momentum in that share, our model told us not to go into that share. So we believe the way that the model picks shares, it actually reduces risk, and it chooses not purely the highest dividend yielders, but also companies where there's good sentiment and where there is an expectation of dividends to grow.
Adriaan, just focusing on basic materials, in October you had a large underweight position in basic materials and they outperformed the Swix by some 2.9%. Obviously that impacted your alpha negatively. Where to from here on basic materials?
Bronwyn, that's a very good point. I think it's worked for the fund. It worked very well for the fund throughout the year, being underweight resources. Last month we added Sasol because it's a very good dividend yielding stock, and the sentiment is starting to change. Now what we see this month is that some of the good quality resources like Billiton is also now starting to find its way into the model. It's not a bad dividend yielding stock. I think it's 3.2%, and we will definitely include Billiton going forward. And on the other hand, we're starting to see some of the more expensive dividend yielders that were in the fund, like the healthcare sector, that we will probably downweight at this stage as they run out of steam.
That's an interesting point, Adriaan, and one I'd like to touch on there. Obviously, many people view healthcare almost as utilities. They have hospitals. There are people that are always sick and that need medical treatment, and these companies are able to pay fairly constant dividends. So at this point, as far as I can see, you don't have any of the healthcare providers in there. Could you give us the reason? Is it just purely a valuation metric that's kicked them out, or are there other things that you've seen there that don't warrant inclusion in your portfolio?
Warren, I think once again, I think the healthcare sector has been a great contributor for the performance of this fund. We had them in the fund for the whole year, and now the momentum is starting to run out of that sector, and together with the dividend yield not being that attractive anymore compared to some of the other stocks, that kicked them out.
When you're referring to momentum there, are you referring to the price momentum of the share or the earnings momentum of the company?
We're looking at the price momentum. We believe there's a lot of intelligence in market sentiment that you can read from the price momentum. The price tells you a lot about the sentiment behind the company.